You've probably heard it 100 times. Buy real estate. It's the key to building wealth. But no one talks about what happens after you buy it. The repairs, the vacancies, the 3 a.m. plumbing emergencies. But what if there was a way to earn real estate income with zero property drama? In this video, I'm going to show you and Josh how REITs, that's real estate investment trusts, let you collect monthly income from commercial and residential properties without owning a single building. We'll break down what REITs are, how they pay you, and how to build your own income-focused portfolio depending on whether you're in your 30s, 40s, or 50s. And by the end, I'll show you how this strategy could snowball into a portfolio worth more than $500,000, paying you over $5,000 a month in dividends for every stage of investing. Before we start building your retirement plan, let's get on the same page about what REITs actually are. A REIT, short for Real Estate Investment Trust, is a company that owns or finances income-producing properties like apartments, warehouses, data centers, hospitals, or even office buildings. By law, REITs have to pay out at least 90% of their taxable income to investors as dividends, which allows investors to earn a steady share of rental income without ever owning or managing property. In simple terms, that means when tenants pay rent, the REIT collects it, covers its expenses, and then passes most of the profit straight to you, the investor. Your income doesn't come from speculation or trading, it comes from real-world rent payments. Each REIT's growth depends on two key factors: dividend yield, how much income it pays each year, and dividend growth, which shows how quickly that income rises over time. The strongest REITs combine both, offering consistent income now and long-term growth as property values and rents increase. To understand why REITs are so strong, it helps to look at their track record. According to data from the U.S. Federal Reserve, the U.S. REIT market capitalization has grown from under $200 billion in 2000 to over $1.4 trillion in 2024. Despite periods of volatility, including the 2007-2008 global financial crisis, the pandemic downturn, and multiple Federal Reserve rate hikes and cuts, REITs have shown remarkable resilience. Every major economic dip has been followed by a recovery as property markets stabilize and dividends continue to flow. This long-term growth shows how REITs have adapted to changing interest rate environments and market conditions. When rates rise, REIT valuations may dip temporarily, but when rates fall or stabilize, the sector often rebounds strongly, as seen after both the 2008 crash and the 2020 pandemic, when REIT market values surged again. That's what makes REITs so valuable. They combine the stability of real assets with the flexibility of stocks. Instead of just hoping your savings will last, REITs give you consistent income, long-term growth, and a way to turn real estate cash flow into a compounding wealth engine. Now that you know how REITs work, let's talk about the tools that make them truly powerful. Because it's not just what you invest in that matters, it's how you invest. The first tool is tax-advantaged accounts, things like a 401k, traditional IRA, or Roth IRA. These accounts are designed to help your money grow faster by protecting it from taxes. For example, a Roth IRA lets you pay taxes now so that all your future growth, every dollar of dividends, every bit of appreciation, becomes 100% tax-free. This means if your REIT portfolio is growing to $1 million and paying you $50,000 a year in dividends, you don't owe the IRS a single cent. The second tool is dollar cost averaging, investing a fixed amount every month, no matter what the market's doing. You're not trying to time anything, you're just building steadily. When prices drop, the same fixed amount will buy you more shares. When prices rise, it will buy fewer. Over time, this smooths out the bumps and keeps emotions out of your decision-making. And the third tool, maybe the most underrated, is dividend reinvestment. Instead of taking your dividends as cash, you reinvest them to buy more shares. Those extra shares then pay their own dividends, which buys even more shares. It's income feeding income, the snowball effect that turns steady investing into unstoppable growth later down the years. Now let's talk about how time turns all those simple habits, steady investing, reinvesting dividends, and staying consistent, into real growing income. Time is the multiplier that does the heavy lifting in your portfolio. It doesn't matter if you start small. What matters is that you start early and stay consistent. Think of compounding like a snowball rolling down a hill. It starts small, but with every turn it picks up a little more. At first your progress feels slow. Then one day the results start growing faster than you can keep up with because your dividends begin earning their own dividends. Let's walk through an example. Suppose you invest $500 a month into a portfolio of REITs that averages a 5% dividend yield and grows about 7% per year in total value. After your first year, you've contributed $6,000. With reinvested dividends and a bit of price growth, your balance ends up around $6,500. If you stop there, you would be earning roughly $325 a year in dividends. But if you continue, by the end of year 2, you've put in another $6,000, $12,000 total. But compounding starts to show. Your portfolio would grow to around $13,600, and your annual dividend income nearly doubles to about $680. By year 3, you would have invested $18,000, and your portfolio would have climbed to roughly $21,000, and now it's paying you about $1,050 a year. That's money you didn't have to work for. Income generated simply because time, consistency, and reinvestment were doing their job. The longer you stay invested, the faster that snowball grows. But here's the key, not every REIT grows the same way. To make compounding work its hardest, you need quality REITs that consistently pay and grow their dividends year after year. So let's talk about how to spot the right ones. Not all REITs are built the same. Some are income powerhouses that keep paying and growing for decades, while others look good on paper but crumble when the market tightens. The difference often comes down to a few key traits that separate the reliable from the risky. The first thing I look for is dividend consistency. If a REIT has been increasing its dividend year after year, through recessions, inflation, and rate hikes, that tells you it's run by people who know how to manage through any environment. Dividend growth is proof of discipline and profitability. Next, I check how sustainable those payouts really are. Every REIT must pay out at least 90% of its taxable income, but the smart ones keep enough cushion to reinvest and grow. If a company is paying out more than it earns, that's a red flag. Sustainable payouts means predictable income. Then there's debt and occupancy, two numbers that show a lot about how stable a REIT really is. The best companies use debt like a tool, not a lifeline. They borrow strategically, manage risk carefully, and keep their properties full. A strong REIT usually maintains occupancy rates above 90%, which shows steady demand and loyal tenants. I also look for a balance between yield and growth. A 3% yield that grows 10% a year beats a 7% yield that never moves. High yield might look exciting today, but long-term wealth comes from steady growth. And finally, management quality is everything. You can have great assets, but if the leadership team makes poor decisions, it all falls apart. The best REITs are run by experienced managers who know how to allocate capital wisely, protect shareholder value, and grow through changing markets. When you find REITs that check all these boxes, consistent dividends, sustainable payouts, healthy balance sheets, and strong leadership, you found the ones built to last. Next, I will break down the 3 ETFs I selected based on these criteria. Then I'll show you how to build your own income-focused portfolio depending on whether you're in your 30s, 40s, or 50s. And in the end, I'll show you how to reach a portfolio worth more than $500,000, one that pays you over $5,000 a month in dividends for every stage of your life. But first, let's look at 3 real REIT examples that work beautifully together: Extra Space Storage, Torino Realty, and Getty Realty. These 3 are different in size, strategy, and style, but together they form a complete overview of what a smart, income-focused portfolio looks like. Let's start big with Extra Space Storage with the ticker symbol EXR. If you look at the company profile, you'll see it stands head and shoulders above the others with a market cap of around $31.6 billion and over 8,000 employees. EXR operates in the self-storage industry, a sector built on a surprisingly stable truth: people always need space. Whether the economy's booming or slowing, storage demands tend to hold steady. People move, downsize, or relocate for work, and EXR earns consistent rent month after month, making it one of the most dependable names in the REIT world. Then we've got Torino Realty, smaller, leaner, and laser-focused. With a market cap of around $6 billion and fewer than 50 employees, TRNO operates in industrial real estate, renting out warehouses and distribution centers in key U.S. port cities. These properties are the backbone of e-commerce, the backstage where your online orders move before reaching your doorstep. TRNO's strength lies in efficiency. It reinvests aggressively, grows fast, and stays nimble in a space that's essential to modern logistics. Finally, there's Getty Realty, the smallest of the 3. Valued at about $1.5 billion with just a few dozen employees, GTY focuses on retail real estate, particularly gas stations and convenience stores, places that people visit every single day. These are long-term, essential-use properties leased to strong tenants like major fuel brands and convenience operators. So while GTY may not have the size or growth potential of EXR or TRNO, it has something equally valuable: stability. Now, when you look at their financials side by side, the differences are clear. EXR generates roughly $1.9 billion in operating cash flow, far larger than TRNO's $243 million or GTY's $134 million. But that doesn't mean EXR is automatically better. TRNO's smaller scale actually lets it reinvest a higher percentage of cash at higher returns, fueling faster growth. GTY, on the other hand, keeps capital spending incredibly low, under $1 million, so nearly every dollar it earns can go straight into dividends. EXR sits comfortably in the middle, balancing steady growth with generous payouts. Then there's risk, and this part is fascinating. When you look at the risk table, you'll see something fascinating. Over the past 5 years, EXR has had a 60-month beta of 1.11, which closely matches market movements. TRNO trails at 1.06, moving nearly in sync, but with a touch less sensitivity. Then there's GTY, with a 60-month beta of just 0.84, meaning it's far less affected by broad market swings. Zooming into the shorter 24-month window, EXR drops to 0.71, TRNO sits at 0.78, while GTY plunges to just 0.16, practically detached from market turbulence. In short, EXR and TRNO move with the market, while GTY stays calm when others swing. Now look at short interest, a measure of how many investors are betting against a stock. EXR has the lowest at 1.74, signaling strong investor confidence. TRNO comes in higher at 5.72%, which fits its higher growth, slightly higher risk profile. GTY tops the list at 6.41%, although that's more a result of its smaller size and lower trading volume than weak fundamentals. Now let's connect all this to performance. Looking at the 5-year price return chart, we can see how differently each REIT reacts to changing market conditions. EXR, shown in orange, leads the group with about 26.6% total price return, a strong performance that reflects its scale and steady demand in the storage sector. TRNO, in blue, follows with a 0.68% gain, while GTY in pink edges slightly higher at 1.06%. At first look, those numbers might seem low, but they don't tell the whole story. Over the last 5 years, REITs have been navigating one of the toughest environments in decades: rising interest rates, inflation, and major swings in property values. Let's take TRNO as an example. Its 5-year performance was 0.68%, but if you zoom out to 10 years, you can see it managed to grow by over 171%. Through it all, EXR has shown the sharpest price movements, climbing fast in good times, pulling back when rates rise. Classic behavior for a large REIT that moves closely with broader market trends. And then there's GTY, the calm one in the group. Its focus on gas stations and convenience stores keeps it almost untouched by volatility. When the rest of the market swings, GTY stays grounded. A perfect example of why low-beta REITs can bring peace of mind when everything else feels uncertain. So how do you use that information? Well, think of them like roles on a team. If you're in your 30s, TRNO's growth potential fits perfectly: fast, focused, and compounding. In your 40s, EXR becomes your steady anchor, big enough to weather anything while still growing. And in your 50s or beyond, GTY steps up as your reliable paycheck, slower moving, but dependable, paying you even when the market's rocky. You're not picking a single winner, you're building balance: growth from TRNO, stability from EXR, and income from GTY. Together they create a portfolio that can grow, stabilize, and pay you, all at the same time. Now that we've seen how each of these REITs contribute to the bigger picture, let's put them into action. I'll build a real example, the growth portfolio, designed for investors in their 30s. If you're in your 30s, your biggest advantage isn't experience, it's time. Time to let compounding work, to reinvest your dividends, and to let every small contribution snowball into something meaningful. The growth portfolio is designed exactly for that: to grow fast, reinvest smart, and keep your income accelerating. Here's how it's built. Starting with Torino Realty at 45%, this is your main growth driver. TRNO currently offers a 3.58% dividend yield with an incredible 10-year dividend CAGR of 12.01% and an average annual share price appreciation of 11.47%. That combination of fast dividend growth and double-digit price gains makes TRNO the engine of long-term wealth here. The larger allocation reflects your ability, at this age, to embrace a little more volatility in exchange for higher returns. Next is Extra Space Storage at 40%, the portfolio's stability core. EXR is a self-storage powerhouse that performs in every type of economy. Its metrics are rock solid: a 4.54% dividend yield, 11.82% 10-year dividend CAGR, and 6.33% annual price appreciation. EXR is the dependable middle ground, offering both income and consistency. It gives your portfolio a push while also smoothing out the bumps from TRNO's faster moves. Finally, Getty Realty takes 15%, acting as your high-yield anchor. GTY delivers a 7.04% dividend yield, paired with 7.64% dividend growth and 4.83% annual price appreciation. It's less about explosive expansion and more about dependable income. Together, these weights create a perfect long-term mix for investors in their 30s. The average portfolio dividend yield sits at 4.48%, with 11.28% average dividend growth and 8.42% annual share price appreciation. If you're starting to invest in your 40s, you're in a unique position. You've likely got more financial stability, a clearer sense of your goals, and maybe even a little urgency to make your money work smarter. At this stage, it's not only about chasing growth, it's about finding balance between building wealth and protecting it. That's exactly where the balanced portfolio comes in. It's designed for investors who are starting in their 40s, people who want strong, steady growth, reliable income, and a smoother path forward through whatever the market throws their way. Here's how it's structured. Starting with EXR at 35%, in the 30s portfolio, it played a supporting role to TRNO's aggressive growth. By the 40s, stability becomes more important, and EXR delivers that. The equal weighting now positions it as the portfolio's anchor, providing dependable cash flow and steady growth to maintain balance through market ups and downs. Next, TRNO, also at 35%, continues to drive the growth engine forward. This is not an abandonment of compounding, but a rebalancing. TRNO serves as the bridge between ambition and caution, maintaining exposure to expansion potential while reducing the volatility associated with a heavier allocation in the earlier portfolio. Finally, GTY increases to 30%, the most significant shift in allocation. Previously a smaller component, it now reflects the greater emphasis on income. GTY supplies consistent, reliable cash flow and acts as the portfolio's safety net. Together, this mix delivers a 4.95% dividend yield, 10.63% dividend growth, and 7.68% annual appreciation, a perfectly balanced equation between growth and income. Now, if you're in your 50s, the entire purpose of investing changes. It's not too late, but the priorities have to change. GTY takes the lead with a much larger allocation, 55% of the portfolio. That's because, at this stage, income reliability becomes more valuable than chasing double-digit growth. GTY's high, steady yield ensures your portfolio generates predictable monthly cash flow and starts paying early. EXR and TRNO take smaller roles now, 25% and 20% respectively, but they're still essential. They provide a layer of protection against inflation and keep your total portfolio from stagnating. EXR adds consistency, the slow and steady compounder that quietly grows your income base, while TRNO adds a spark of growth to keep your purchasing power strong over the next decade. Together, this mix gives you about 5.7% dividend yield with an average 9.5% dividend growth rate and roughly 6.5% annual appreciation. Now, let's take this one step further and see how these portfolios perform when projected into the future. How much would you need to invest at each stage of your life to reach that $5,000 a month income goal? And what would your portfolio actually look like when you get there? Let's start with the growth portfolio, built for investors in their 30s. Since you've got time on your side, maybe 30 years or more before retirement, you don't need to start with a huge amount. What matters most right now is consistency. Even something as small as $120 a month can set the foundation for real wealth over time. Let's see how the $120 a month works out. The chart shows two lines, blue for the portfolio balance and orange for annual dividend income. By the end of the first year, you would have invested around $1,440 in the growth portfolio. This sets the stage for future growth. By year 10, the portfolio is projected to grow to about $28,000, paying roughly $1,000 a year in dividends. By year 20, the compounding curve will steepen. the portfolio is expected to reach around $143,000, generating about $9,000 annually. And by year 30, the effect of long-term reinvestment becomes clear. The balance is projected to climb to roughly $744,000, producing around $64,000 in annual dividend income, more than $5,000 a month. Next, let's look at the balanced portfolio, designed for investors starting in their 40s. If you look back at the growth portfolio, you'll notice something interesting. Most of that explosive growth happened in the last 10 years. That's the strength of compounding. But if you're starting in your 40s, you don't have quite as much time to wait for those late-stage gains to kick in. That means your strategy needs to shift. You'll need to invest more upfront to give your money a head start, so it can still grow into that same $5,000 per month income goal. For this to work using the balanced portfolio, you'll need to start with an initial investment of around $30,000 and contribute about $300 a month. Based on this, by the end of the first year, your portfolio will be valued at roughly $37,500, generating around $1,500 in annual dividends. By year 10, it's projected to grow to around $173,000, paying about $10,000 a year in dividends. By year 20, the effect of compounding really shows. The portfolio is expected to reach roughly $792,000, paying $58,000 dividends annually, which equates to almost $5,000 a month. Finally, let's look at the income portfolio, built for investors starting in their 50s. In earlier portfolios, most of the major growth came in the later years. Since you don't have the luxury of waiting decades for compounding to work, you'll need to invest more upfront to reach the same $5,000 a month income goal. For this strategy to work using the Income Protector portfolio, you'll start with an initial investment of $240,000 and contribute around $500 each month to keep your income growing. Based on these numbers, by the end of the first year, your portfolio will be valued at roughly $275,000, paying about $14,000 in annual dividends. By year 5, it is projected to climb to around $473,000, with annual dividends growing to roughly $27,000. And by year 10, the portfolio is expected to reach approximately $935,000, paying about $61,000 a year in income, which is over $5,000 every month. Want to know how to turn a one-time $500 investment into a portfolio that pays over $4,000 in monthly dividend income? Click the video on screen to find out.